This video covers Chapter 24.
It's entitled Investment Companies, but it's really the best title for this chapter is Funds. Mutual funds, or just plain funds, is the term, because we're going to look at a variety of investment companies, which means we're going to be looking at a variety of funds in this chapter. The chapter 24 seems out of place. It's not. It really can be moved in the order that I have it, or which is early in the semester. So, what is an investment company or a fund? Well, it's basically the pooling of money by individuals into a company, and the company that has that money professionally manages a portfolio of securities, and you own each investor owns a proportional share of their investment in that fund. So basically, you or I, we don't want to manage our own money. We say we don't know how to manage our own money, and so we're going to pay somebody to manage our money through these funds. And so let's say we got $100,000. We pooled, a whole bunch of us pooled $100,000 together, and we sent it off to Vanguard or Fidelity or T. Rowe Price. These are mutual fund complexes. That $100,000 will be taken, they'll invest it, and they'll manage the portfolio. And there's a lot to it. So they're not going to do it for free. There's going to be some expenses to it, but overall it's a pretty good deal, and we'll talk about why that is the case for the basically what's the motivation for funds, because you got to ask, if there's hundreds and hundreds, if not thousands of funds, well, in fact there are thousands of funds, why are there so many and why are they so popular? Okay, before we get any further, you can't go anywhere in the world of talking about funds without computing a net asset value, NAV. So I'm going to compute and show you how to compute a net asset value. Okay, so whenever you see the word net asset, that means assets net of liabilities. So that means equity. So it's equity value per share, and this is basically the net asset value per share, which we call the NAV for short, is computed as the equity value per share. So you're going to take the market value of your assets in the portfolio and that the fund owns, minus its liabilities, and that's the equity, right, divided by the number of shares outstanding of the fund. That is the NAV. So if I gave you an example, if we had a market value of assets, the fund had $20 billion under management in portfolio of stocks and bonds and receivables and cash of $20 billion, and you had liabilities of, say, $2 billion. And remember, mutual funds and investment companies, since they're companies, remember, they're companies with a balance sheet and income statement, and operations and things like that, and so they're going to have assets, they're going to have liabilities, and the liabilities in this case would be such things as, you purchased a security. Let's say you purchased a security today, but you haven't paid for it yet, so you owe that money, and so you may be recording the asset on your books, but there's a liability due. You're going to have to pay the cash probably in 3 days. Typically it takes about 3 days for a security to settle. Also, people may redeem their shares, and when they redeem their shares, they don't get their money back immediately. So if you or I invested in Vanguard or Fidelity, we wanted our money back, we'd call up, we'd want to redeem, and you can even redeem over the internet, obviously. It's going to take a couple of days to process, in which case they're going to accrue a liability for the amount of money that they're going to pay you. It'll be like a payable. So funds will have a liability. They'll also have a number of shares. So let's say they have 3 billion shares. Okay, 3 billion shares. So the NAV would be 20 minus the 2. It would have $18 billion in net assets divided by the 3 billion shares, and this would have a $6 per share net asset value. So if you bought into a fund, and we'll talk about what loads mean in a little while, and it's a no-load fund, meaning there's no front-end fees, it's going to cost you $6 to buy into that per share. So, like I said, net asset value, you can't go anywhere talking about investment companies without first understanding that net asset value per share. It's disclosed every day, every trading day. It's computed at 4 o'clock in the afternoon once a day. It has to be shipped off, meaning it has to be sent by wire to the newspapers and other financial press, I think by 5:50 p.m. and so that the rest of so the world can view it and people can figure out what their net asset value per share is for their fund. Okay, now let's talk about the motivation for investment companies. Now that we know something about a little bit about them, okay? There's a couple of reasons for investment companies. The first one happens to be economies of scale. And economies of scale basically mean, if you remember back from your microeconomics, economies of scale, they drew a graph and they put in usually on this axis the size, and in the context of what you learned in micro, it usually be the size of the plant, the size of the firm. Okay. And then here they would have some type of cost, and so here we want to be specific because we're dealing about mutual funds. And so what we want to say is that the cost, the average cost, the cost per dollar invested, okay, and that would be the average dollar cost. The average cost per dollar invested is what I want to label this axis as. And basically it's going to look something like this when you get economies of scale. You may remember this from micro. And so this would be your average total cost function or curve, basically. And what it says is, look, it says if you have a very small size firm, or in our case with mutual funds, a small fund where there's not a lot of money invested and few investors, then you're going to have very high costs per share on average. For every dollar, or for every dollar invested, you're going to have high costs. So maybe this is like 12 cents per share up here when you have very small fund. And then as you get more and more investors and more money pushed into the fund, and you start moving out in this direction, your costs go down because you're spreading your costs, your fixed costs now, across many dollars. And so you're spreading your legal costs of your legal team, your accountants, just people's, other, organizational costs that are involved. They get spread out, and so your costs come down. And then you hit some sweet spot right here. Right here you hit a sweet spot, and you hit a minimum average total cost. And then things start to spike up. And if you remember from your micro course why things start to spike up, well, after a while certain organizations, they get too big. When they get too big, they get unwieldy, difficult to manage, and costs actually go up. Now in terms of mutual funds, this is not uncommon. It's not uncommon to start moving up here in this direction, and that often comes about by firms having to do extensive searches to execute their strategy of the mutual fund. Nearly every mutual fund has a strategy, and if it's an actively managed portfolio, which means it's trying to beat the market, as opposed to a passively managed portfolio, which may be trying to mimic an index, or at least trying to match the market, an actively managed fund has a strategy to try to beat the market, and they have a particular set of stocks that they sort through, and criteria that they're looking to sort through and pick. Well, after a while, the fund gets so large, it starts running out of the best players, so to speak, the best stocks that meet their criteria, and they've got to go into stocks that don't quite meet their criteria. They're close, and then after a while, they end up buying stocks that don't do very well. But in the search for those stocks, their costs go up. So Fidelity's Magellan fund had that problem, back in the 1980s, early 90s, Peter Lynch ran Magellan Fund in Fidelity. It was the most popular fund at the time. It was the largest fund. He outperformed the market for quite a while. He did great, but as he said in his books and his discussions with the media, he said after a while I got so big that I had to take giant positions in companies that actually moved the market and had significant price impact. And not only that, but I had to get people basically to scour the world to try to find stocks that met his criteria, because he ran out of stocks in the United States that met his criteria, and he had to go worldwide, and that just costs more money. So your costs can go up. So if a fund is smart, they'll try to balance it, figure out where they are right here. Where they are right here, this is very hard to figure out. Where it is, all you can say is at some point your costs will go up depending on the cost structure of the firm, and all firms will be different. Okay. So economies of scale are one reason for the motivation of funds. The other reason is diversification. And this is a big reason. You get diversification. Okay. Diversification comes about because you're going to end up buying into a fund that may have 300 or 400, 500, in some cases thousands of securities in it. Well, if you try to manage that yourself, do you know how much of a nightmare that would be? I mean, think about it in stock track. You're going to be managing a couple of stocks in your portfolio, and you're going to see that it's quite a bit of work to find them, to track them, and to manage them. Can you imagine how hard it is to do a couple hundred? So when you get into a fund, you're going to get instant diversification. And so what that looks like here is you're going to have your number of assets, probably stocks in most cases, or bonds, and then you're going to have risk on this axis, and the benefits of diversification will look like this. And you've had to have seen a graph like this in your previous finance course. I'll be using this graph throughout this semester, and what it means is, look, this curved line, I call it the sliding board graph, is basically your total risk. Total risk, and your total risk is made up of company specific risk in this area right here. It's company specific risk right here, and then systemic macroeconomic risk here. So this is systemic, and you can say this is unsystemic, okay? And this is macroeconomic risk, and this is company-specific risk, and the total is unsystematic plus systematic risk equals your total risk. Now notice that the risk doesn't get eliminated here. It comes down to a point, asymptotically comes down to a point, and that point is basically the systemic risk that you cannot get rid of, you can't diversify away. It becomes very important in Chapter 7. And we'll talk about it much more in that chapter. But here's what I'm saying. I'm saying, look, as you start from a portfolio of, say, 0 stocks, or maybe just 1 stock, think of it as 1 stock, and you start increasing the number of stocks, and you're moving in this direction, eventually you're going to start looking like the market portfolio, because you're going to have every single stock in your portfolio. And when you have every single stock in your portfolio, you still have risk. You have not gotten rid of risk. You still have some, but you have the benefits of diversification, which means you've gotten rid of company-specific risk. Here, it's netted out. So you've got good news about a new product coming out, but in one company, but the new product in one company may have a negative impact in another company, and the price of oil may be good for some companies, but bad for others, and so on and so forth. And so you have company-specific risk, which nets out. And so your volatility comes down, but it doesn't get eliminated, obviously. So if you think of the S&P 500 as a good benchmark for the overall market, you hold the S&P 500, take a look at the charts. The S&P 500 bounces around quite a bit, but not as much as an individual stock. And so this total risk is measured by sigma, your variance of your portfolio. Your systematic risk is measured by beta. And we'll have a lot more to say about that in later chapters. But the benefits of diversification are really important in a mutual fund. especially when you're looking at retirement money. You do want diversification. You'd never want to be here with your retirement money, which means you've bought only one stock, because you're looking, if that stock goes belly up, you're not going to be able to retire. Okay. So here you see the first three motivations, first two, and I'm going to cover three motivations, but the first two are all about, risk and return. In other words, when you have lower costs, the fund has lower costs. That means you get to keep more of the returns that the portfolio generates. And so investors like this because they make extra income. Here you get lower risk, and there's no sacrifice in returns. When we cover Chapter 7 and we discuss modern portfolio theory, you're going to see that there's no sacrifice in returns when you diversify. So there's no sacrifice here. You get lower costs, which means higher returns here. You get the best of both worlds with investment companies, with funds, which is why they're so popular. The other reason that they're so popular is item number 3. You have professional management. And with professional management, you've got somebody else doing the bookkeeping, making the buying and sell decisions, determining the tax consequences, tracking risk, and doing all these things that take quite a bit of work, special software and expertise. And again, you'll better appreciate this at the end of the semester when you have to write a report on your portfolio, which may have only had, maybe you had 20 stocks throughout the semester, and at any given time you may have held 5 at a time. But with portfolios in mutual funds, you're going to see hundreds of different stocks, bonds, also having derivatives. It's all managed for you. They give you nice clean statements, tell you at the end of the year, this was your short-term capital gains. Put this in the box, whatever, on your in line, whatever, in your tax return. And here's your long-term capital gains. Put this in line, whatever, in your tax return. So it's all nice and clean for you. Okay. Now what we want to do, so we just discussed the 3 main motivations for investment companies. Now what I want to do is I want to talk about the types of funds that are out there. There's a number of them. In fact, there are not only funds, but there's things that look very closely like funds, which we should discuss. And so let's talk about some of the types of funds that we have that fall under this chapter. And some of this is not in the text, so you need to listen up. But I think closed-end funds are in the text. The first one I want to do is cover closed-end funds. Okay. A closed-end fund is an investment company that doesn't sell any more shares. It basically does an IPO, an initial public offering, sells its shares, and those shares trade on an exchange. So closed-end funds trade on an exchange, and the shares sometimes may sell at a premium or discount relative to their actual net asset value, which is kind of funny, because what happens is these shares trade based on supply and demand, the market price that they trade on an exchange, like the New York Stock Exchange. Those prices are determined by supply and demand. Underneath that is like a book value type thing, and that's what the net asset value is. So these funds will compute a net asset value, and the net asset value may be, I should say the market value will be above or below the net asset value. If the market price is a little bit above, it means that that portfolio is trading at a premium. And there could be reasons for that. It could be that there's a portfolio effect, and then investors for some reason think this portfolio of particular stocks is very attractive, and it's difficult to form a portfolio yourself. You're going to have to collect the right types of stocks in the portfolio, assemble it yourself. It'll take time and money. So if you buy into a closed-end fund that's very sector specific, which they can be in a very interesting niche, there could be a premium for it. There also could be discounts associated with it. It could be tax consequences that you're buying into. And so the tax issues, which we don't really get into that much, but they could be trading at a discount. So, which is quite interesting. You know, sometimes the premiums and the discounts are so much that financial economists can't figure out exactly why they're so big. And so that leads to the possibility of market inefficiencies or questions of market inefficiency. Why does the actual market price deviate so much from the net asset value? And it does at times, and it may vary, that premium or discount. Okay. So now with closed-end funds, what's interesting is with these funds, there's no shareholder servicing fees and expenses associated with it. Because the shares are outstanding, they're trading amongst the public through an exchange. The company basically does the IPO, sells the shares, and is not very much involved in the activity of transferring money among accounts. Compare that to open-ended funds, which is the next one I want to do, which are really called open-ended funds or mutual funds. These are by far the most popular. These closed-end funds are popular. You'll find them listed in the Wall Street Journal. They're out there, but this is gigantic. Open-ended funds. Open-ended funds, they'll issue shares, and they'll keep issuing shares. And so that's why they're open. They don't do an IPO and there's a fixed number of shares outstanding in the market. These guys, they issue shares directly to shareholders, and these shares are not traded on an exchange. So if you go into an open-ended investment company or fund, you can't trade your shares with other investors or through a broker to another investor. You got to redeem your shares with the investment company themselves. It's kind of like opening up a CD with at a local bank. You can't trade that CD with another investor. You got to go back and redeem that CD at your local bank. So that's the way open-ended funds work. But open-ended funds have giant shareholder servicing departments, which drive up their costs a bit. Okay? These closed-end funds don't have that because the shares simply trade on an exchange. They don't have to worry about redemptions in closed funds. But with open-ended funds, you can get economies of scale that you couldn't get in closed-end funds, because the fund could get bigger and bigger and bigger and bigger, and who knows exactly where the uptick is in the average total costs. The average total cost could be quite flat for a while, and so you could have a good sweet spot for quite a while. So open-ended funds are by far the most popular. Investment companies love them. The companies that sponsor these funds love open-ended funds because the fees that the managers charge from running a mutual fund are a function of the net asset value. So the more money that this company manages, the more money people funnel into a company, the more fees that the investment company manager earns. And so these are quite attractive because of that. So you get economies of scale, and that's important. If you look the way at traders, especially retail traders, as I've mentioned in class before, almost always mistime the market. They buy high and sell low. They do exactly opposite of what they're supposed to be doing. And how does that happen? Well, if you look at a whole bunch of studies in finance, I'll tell you how it happens. Investors get quarterly reports. They're in Fortune magazine, they're in Barron's, they're in the Wall Street Journal. Any financial newspaper will have them quarterly, and they'll look at and they'll show you the best performing mutual funds for the quarter. Okay, so they're looking backwards at the quarter. And so what do investors do? They go, oh wow, look at this XYZ fund, this did a great quarter, they're hot, I'm going to buy them. And so when that happens, you tend to be buying after the fact, when the net asset value, has been driven up significantly. And remember, net asset value, NAV, is equal to the market value of the assets minus the liabilities divided by the number of shares. What's really causing the net asset value to spike is the underlying assets in the portfolio. This is the driver. The liabilities don't change a whole lot. This guy is what's driving the NAV. And so if they have a hot hand, you know, on a particular type of strategy or type of investments, they're doing well, investors after the fact start pouring their money in, after the price has gone up, start buying. And by the time, and when they buy, they're often disappointed because they buy at a peak and the market tends to drop after that. The market value falls, the net asset value drops, and they're disappointed, and they end up buying high and selling low because they're looking backwards. So it's part psychology. Investors hate buying things that have sunk and have dropped. I know, I can tell you from experience, even though I understand these biases, which we'll cover in Chapter 6, we'll cover these biases, but it's very hard to go against those. It's like human nature. People want to buy things that have done well, but that's when you're paying an expensive price for it, and so you got to keep that in mind. People don't like to buy losers, but if you talk to any seasoned investor, they're going to tell you that's, you know, I'm not sure if loser is the right word, but you want to buy a good stock at a discount if you can after it's dropped. Okay, so those are open-ended funds. You can buy them on StockTrack. I believe you could buy these closed-end funds. If you get the ticker symbols for these things, you can buy them in StockTrack. Another one that, and you can buy these under the mutual fund section, under the mutual fund pit. These two, they have net asset values. These guys. There's a third one that has a net asset value, and they're called exchange traded funds, ETFs. Extremely popular. They have a net asset value, and these three guys right here, these three types of funds, are all covered by the Investment Company Act of 1940. So mutual funds have been around for a while, and so the rules and regs are under that cover these three types of funds are Investment Company Act of 1940. So exchange traded funds, what are they? Well, they've only been around about 20 years or so, and they're basically a hybrid. They're a hybrid in the sense that the shares trade like a closed-end fund. So these things trade on an exchange. They trade in the stock pit. Listen up, stock pit in StockTrack. You don't buy these exchange-traded funds under the mutual fund section. You buy them under the stock pit, and you're going to pay a commission, a brokerage commission, to buy these. Okay, just like a stock. Okay, but this exchange-traded fund is you're basically buying into an open-ended type fund that trades all day on an exchange. And so this open-ended fund can get bigger and bigger and bigger. Most exchange-traded funds track indexes, which means they're passively managed, meaning they're not trying to beat the market. They're not actively trying to beat the market. They follow indexes like the S&P 500. So you got things like the SPDR, the S&P 500. You got SPDR ETFs that track S&P 500. You have the QQQ, which tracks the NASDAQ index, and you got diamonds, for example, that track the Dow Jones Industrial Average. So they got some nice names to them. And so these things, what's really good about these things is they trade all day, just like closed-end funds. Okay, so they trade all day. They have a supply and demand, which may cause the price to change a little bit differently than the net asset value. But usually the NAV stays close to the market value because there's mechanisms at the funds to control for that prevent the net asset value and the market value that's being traded on an exchange to differ very much. So ETFs are extremely valuable because you get to buy in one click. You can buy 500 shares of the S&P 500, and you can buy them at any time of the day. And not only that, but you can short them. You can trade them on margin. You can't short these guys. You can't short a closed-end fund or an open-ended fund. And so they're not very flexible. Exchange-traded funds are very flexible in that way. So you're managing. So these things, while they are passively managed indexes, nearly all of them. There's only one that I know of that I heard on TV the other day that's actively managed, and that's the PIMCO Total Return Fund. PIMCO, Pacific Investment Management Company. They've managed bonds on the West Coast. Bill Gross, if you ever heard of him, used to run it. And their total return fund is actively managed. But I think all the other hundreds, if not thousands of other ETFs are passively managed. They tend to follow indexes. But investors like you and I can use them to actively manage your portfolio, meaning that you wait for the S&P to go up, you can short sell it, or the S&P goes down, you can buy them here low, and when the S&P goes up the next day or 2 days later, you can sell them at a high point, and so on. So you can actively manage these passively managed ETFs. I hope that makes sense. Okay. Now, there are another type of fund that's out there are hedge funds, and you've probably heard of hedge funds. So I'll call this item number 4, hedge funds. Hedge funds have been around for quite a while, but they really got their popularity back in the early 2000s. And the reason they got their popularity was when the stock market crashed in 2000, 2001. These hedge funds were in really good position, and they outperformed the average market, the average portfolio, and the average mutual fund. They did quite well because they had a lot of short positions. So hedge funds, they give you the impression, and a lot of them, they have some very sophisticated strategies that are not primarily long strategies. They can have a lot of short positions. So when the market drops, hedge funds can perform quite well. And they did in the early 2000s, so investors poured their money into these things. Okay? So keep in mind, so I'm doing another comparison here, that when you buy into closed-end funds and open-ended funds, these things are almost nearly 100% long portfolios, meaning they're buying long and holding them usually for a relatively long period of time. Usually not heavy active management. There could be some, but they almost always take long positions. And if you read the prospectus in the prospectuses, it tells you that they have limits on how much they can short sell. With hedge funds, these things are not covered by the Investment Company Act of 1940. You have to be an accredited investor to be able to buy into hedge funds, which means you have to have a net worth, assets minus liabilities, of at least $1 million and have at least $200,000 in annual income for a couple of years. And you got to read the, what the rules are for each hedge fund as far as what an accredited investor are. So these are not for retail investors, whereas closed-end funds and open-ended funds are for the retail investor, which is why they're covered by the Investment Company Act of 1940 to protect the average investor. Hedge funds don't have that protection. So they often operate in a black box, meaning their strategies are not disclosed. You don't know what their strategy is, and they operate in a black box, which can be quite dangerous, which is why there's been a lot of scandals and fraud. You don't see a whole lot of scandals and fraud in open-ended funds and closed-end funds because they're heavily regulated by the Securities and Exchange Commission through the Investment Company Act of 1940. Hedge funds don't have that scrutiny, and so they fly under the radar of the SEC in most cases. And so most fraudulent cases, insider trading cases, the Madoff case, for example, the giant pyramid scheme, they're all operating under hedge funds. So hedge funds can be, there's a lot of interesting strategies in hedge funds. Now, one thing about hedge funds that we're going to talk about, we should talk about fees associated with them. I'm going to talk about fees of closed-end funds and open-ended funds in a little while, but I want to talk a little bit about the fees in charge here. Now, most hedge funds, the typical fee is called a 220 fee. That's the typical fee, and what that means is the management fees per year are 2%, which is fairly high. In fact, more than I'd say about double, almost double of what the average fund is. So they're quite high, which means no matter what happens to the fund, if it performs poorly or performs well, management will take a 2% management fee to cover their costs and some of their profit. And they'll also take a performance fee of 20%, which means any capital gains above what's called a high water mark will be 20% of it will be taken off, skimmed off by the managers, which gives the managers a lot of incentive to try to outperform the market, because they get rich when they outperform the market. So they get rich using your money in a sense, and they help you get rich, and they make themselves rich at the same time, which is probably why a lot of the fraud happens here also, because of this 20%. It could be 30%, depends on the fund. So it aligns the portfolio manager's interests with the rest of the shareholders, which is by itself a good thing, but 20% is quite high in a lot of people's minds. So what do I mean by a high water mark? Well, here's how it works, roughly. And you have to read, caution you, read the prospectus. Nearly everything I'm talking about is a general statement. You need to read the prospectus to make sure exactly what the rules are around every fund. But here's high water marks in general. So let's say you have the net asset value of a hedge fund, and they have net asset value. And the net asset value does this over time. So maybe this was $10, and then this is $50 per share net asset value. So maybe this is right at 30 right here. So what it means is, while the fund is doing well and it's in uncharted territory, it will be charging this 20% fee. So as this goes up, it'll charge the 20% fee. Now as it goes down, they won't charge any fee, but they won't give you a negative fee either. They just won't stop charging the fee on the way down when the net asset value falls. They will not charge the fee all the way up to the new high water mark. So this is the high water mark right here. So when it passes the high water mark, it'll start charging this 2% fee, and it'll charge the 2% fee in this case right here. So it charged it here, and it charges it here. It'll stop charging it, it'll stop charging it, and then it'll pick up and start charging again at the new high water mark. That prevents the fund from double dipping, so to speak, losing money and charging here, and then charging here for this downfall. So you can only charge when you're above a high water mark. That's roughly how they work. Read the prospectus to figure out exactly how that works. There's also a fifth one here, fifth type of fund, and that's private equity. Private equity is not covered by the Investment Company Act of 1940. They'll compute a net asset value, but it's kind of hard because private equity invests in private type assets that are not publicly traded. So it's difficult often to get a net asset value, to get a market value for the underlying shares. They may estimate it periodically, come up with estimates, but they won't do it every day. So these private equity funds, they invest in non-traded assets. And the assets held by private equity portfolios, like I said, they're illiquid. There's often lengthy lockup periods. In other words, because these portfolios are not liquid, you may invest your money and you may have to sign up, so to speak, to keep your money locked into this fund, into this private equity fund, for a year or two before you can withdraw your money. And when you can withdraw your money may only be once a quarter. Hedge funds operate the same way, by the way. They have lockup periods. They could be dabbling in non-traded assets, but these hedge funds, they won't let you back out either. They'll have lockup periods. You invest your money for at least a year or two, and then you can only withdraw in certain time periods. That scares people because there's not a lot of liquidity. When the market drops and it drops in between a quarter and you can't get your money out of these funds, people go crazy because they can't get their money out when they want to get it out. And so they're locked into these funds, and you can only get your money out at the end of a quarter. It may not be good. So you don't want to put your life savings, so to speak, in these things if you're going to somehow need to get access to that money. You may have to, again, read the rules. It could be a gigantic penalty involved in trying to get your money out early. And with private equity investors, you have to be an accredited investor, $1 million in net worth. And usually, by the way, that net worth estimate usually is excluding your house, and then you need to have at least $200,000 annually. In some cases, I think it's $200,000 for at least 2 years in a row, but you can check on that in the prospectus. Okay, there's also another thing. They're called venture capital funds. Venture capital funds are not investment companies, so they're not covered under the Investment Company Act of 1940. But venture capital just means that they're buying into very young companies, and it's especially in and of itself. You're looking at the entrepreneurial world, and it's very different than what we're talking about mainly for traded securities. They'll buy into these ventures, and they may be managing a portfolio of maybe a dozen or so securities, and so I'll just put here venture. They may be invested in a dozen or so. I should just call them companies, because they'll invest in mainly only a dozen companies, because they're going to be not only making a dollar investment in these funds, but they're also going to be on the board controlling and managing the company almost on a day-to-day basis. So there's only so much they can do in terms of the portfolio managers actively helping out in these ventures that make sure they get steered in the right direction. And so when they have a 10 or a dozen companies in their portfolio, they're only looking for a home run on average, maybe 1 or 2 home runs out of those investments, and those investments can last for years and years until a company goes public and gets traded on an exchange. So these venture funds, you can get your money locked up for a period of time, like you can with private equity. Private equity, by the way, also has these managers will also be actively participating in the management of the companies that they've invested in, which is quite different than, see, go back to closed-end funds, open-ended funds, and ETFs. These are passively managed, meaning they're not allowed to take big positions in companies so that they can control the companies. They're not interested in controlling the underlying companies that they've invested in, so they're passively investing. Whereas hedge funds, they might take an active position, like a large position in the company, try to get on its board of directors and control the company a bit. The same with private equity for sure, and venture funds will also try to get on boards. Well, they will be on boards. It'll be in the contract. Another thing, you should be, another fund, last one will come. I got to be really careful. This is technically not a fund, but it's very, very worthwhile discussing, and those are called exchange traded notes, ETNs. These are not funds, so they're not investment companies. They look a lot like an ETF, right? So you often see them labeled and listed along with ETFs, but this thing called note, see that note there, N? If you remember from accounting, you get notes payable and things like that. That notes payable referring to liabilities. So this is debt. So there's no net asset value per share here, right? Because remember what NAV is. NAV equals your equity per share, right? But this is all debt, so you can't have equity per share, so there's no NAV. You just have a debt security whose price is determined, and it's traded all day. The price is determined all day while the market's open based on supply and demand. And so what are these things? Well, this is debt. So you basically fork your money over to a large financial institution, and according to the prospectus, they're going to invest in various securities. Often they'll be investing in derivatives and other securities that may not be very liquid, that may be highly risky, but you don't have an equity position in it. You've basically lent this financial institution money, and it'll tell you that in the prospectus. So you got to read the prospectus carefully. It'll tell you that you're a general creditor, which means that the financial institution goes bankrupt. You're a general creditor. You don't have anything secured. You're in line with everybody else, waiting for the bankruptcy proceedings to end so that you get your money back, but you may not get it back. So the point is, you can buy exchange traded funds or exchange traded notes in StockTrack, and I recommend you trying it. But in reality, in the real world, I would stay clear of these things. You don't want to be investing in these guys. Some of these guys, by the way, some exchange traded notes and even ETFs, so ETNs and ETFs will be leveraged funds. So I just make a note of this because I know you'll come across this while you're looking for various ETFs to buy. You'll come across leveraged portfolios. And with a leveraged portfolio, they'll often be called 2x or 3x portfolios. There's no such thing as 1x. Well, there is such a thing as 1x, but they're never disclosed. 1x are all normal funds, and I'll tell you what I mean by normal when I can show you this. So basically what a 2x or a 3x portfolio does is it has a particular strategy in mind, and it leverages itself. It somehow uses derivatives, options, and futures contracts in such a way so if the underlying index or portfolio, let's say it gains 10%, you will earn 20% with a 2x. Or if the portfolio earns 10%, you'll earn 30% in a 3x portfolio. So it magnifies it, and magnifies it using derivatives. And you can take the financial engineering course that I have, and we could talk about how this works, and you'll get a good feel for it after a while of how it works. The leverage works. But let me tell you, you don't want to invest in these things for the long term. They're only designed for investing in the short term. And here's what I mean. So let me give you an example. Let's say you invest in an index that starts at 100 and it has a 10% return, and it goes up to 110. Okay, so 10% positive. Then the fund drops 10%. When it drops 10%, you think to yourself, oh wow, okay, I made 10%, I lost 10%, I'm back to square one at 100. And actually you're not. You actually end up at $99, because if you take 100 and you grow it by 10%, and then you lose 10%, you're at $99. That's the difference between arithmetic returns and geometric returns. And geometric return here would be a little negative because you just lost $1. So what happens in this, let's say this happened over a 2-day period, and I'm exaggerating, then if you magnify it 2 times, okay, so that now it goes up 20%, right, and comes down 20%, what'll happen is you start out at $100, it grows 1.20, then it drops 20%, you're at, let's see, you're now at $96. So you're off by $4. You're worse. In fact, the more volatility you have, which is driven by the number of times it's multiplied by, the lower you'll go off. Even though you had a 20% return here and a negative 20, you think you broke even, but you actually lost 4. It gets magnified. So the point is, these leverage portfolios will do well over the short run, you know, if you're timing the market. But you don't want to hold these long term, because long term you're going to get eaten alive by the volatility. The underlying portfolio, no matter what happens, is going to go up and down over time, and you're going to get eaten away with this effect. the effect is related to the variance. So you can do calculations and you'll see that it's related to the variance of the underlying returns. At least for a two period, it's not hard to do that calculation. So you need to be aware of that. So that's why these exchange traded funds, exchange traded notes over the long run that are leveraged are not good investments. Okay. Now let's talk about fees and expenses charged by funds. First off, we want to know that there are recurring fees and there's non-recurring fees, and I want to cover the non-recurring fees first. Non-recurring. Fees. Okay. Non-recurring fees, a good example of that would be front-end loads. That's what they're called. A front-end load is basically a charge at the beginning of buying into a mutual fund. Not all funds charge front-end loads, and so my advice would be to stay away and stay clear of those things, because there's no reason to buy into a front-end load. Normally this front-end load is charged because you went through a bank or an insurance company or some type of financial institution, and they helped you and steered you into the right fund. That's typically how it works. It's possible you go right into a fund. The Wall Street Journal had articles on this in the past, that you go directly through the internet or by phone. You call them directly and you move money into them and they charge you a load. They shouldn't really be doing that, but some of them do anyway. The load is really around with the help that you get from a salesperson. And so how does this load work? Well, it's an addition to the net asset value when you buy into a fund. So what's going to happen is when there's a load, there's what's called an offering price. And the offering price is computed as the net asset value, like we computed earlier, divided by 1 minus the load, L. And that's a load in decimal form. And the loads are often they can go from 0, which is a no load fund, all the way up to 5.25% for a load. So this is how it works. So let's give you an example. Let's continue with the remember we calculated an NAV earlier as $6 per share. So let's say we have a fund that has a 3.25% load. Okay, what is the offering price? How much are you going to pay? How much are you going to pay in total, and how much are you going to get pay in expenses in terms of the load, and how much is actually going to get invested in the fund directly? How much money is going to go to work for you? Well, here's how you calculate that. So I'm calculating the offering price, the OP, okay, which is $6 divided by 1 minus the 3.25%. And when I do that, I get $6.40. So it means I'm paying a total to get into this fund. The offering price is $6.40. I'm going to pay $6.40. 40 cents going to get skimmed off the top, get paid to reimburse salespeople to help execute your transaction and advice that they gave you. And the $6, the NAV, is what actually gets invested. So $6 goes to work for you in the portfolio, and this 40 cents is just an expense that you pay. You shouldn't be paying that. There's a lot of there's tons of studies that show that fees like this only hurt you. The performance of the funds are not any better with the higher fees they charge, even around loads. So avoid load funds. Other expenses, there are often back-end loads. A back-end load is a load that you pay on when you exit a fund. They're called exit fees. Sometimes they're called deferred contingent sales fee, for example, or something like that. A deferred contingent sales fee, which means it's deferred, meaning you don't pay the back-end load until you decide to back out of the fund, and it's contingent on you backing out of the fund, and it's a sales fee, a sales charge. It's a fee. The fee could be on a sliding scale basis. See if we get that right. Meaning, you may have to pay a 1% fee if you hold for the first 1 year. The first 1 year, you may have to pay 1% if you back out of the fund. Then over the next year, in the second year, you may only have to pay 0.75% back end, and then year 2 to 3, maybe a 0.5%, and so on. It'll be a sliding scale, so it eventually goes down to 0. Now, a lot of funds didn't have these years ago. Nearly all of them have fees now, back end fees, and the back end fees are designed to discourage active trading of mutual funds. Years ago, people used to actively trade mutual funds. They would dart in and out of the market. So when the market went up, they tried to sell, and they one day, and they would buy the next day. And it's extremely disruptive in the portfolio, because what's happening is, in order for the fund to be able to redeem money, redeem your shares, they have to sell something off in the portfolio, and they may be incurring capital gains and losses in the process. And so what it does is, people may be deciding to bail out one day and buying the next day. It's causing these capital gains and losses. It's disrupting the portfolio, and the other shareholders are paying for that indirectly, are paying for other people darting in and out of the fund. So in order to prevent that from happening and offset those costs, they have back-end loads that are charged to be fair to the other investors there. And it also helps cover the costs of mutual funds having to constantly redeem shares and issue new shares. So those are back-end loads. They are not recurring. These front-end and back-end loads are not recurring because they don't happen every year. Recurring fees are management fees, for example, distribution fees, investment advisory fees, custodial fees. They could be audit fees, legal fees, shareholder fees, because remember, these are companies, they have management that are, and people managing this portfolio all year round, and so these fees are going to get charged. They're going to get charged annually to the fund, which makes sense. There are special fees that you may not know, and they seem kind of weird, and one example would be 12b-1 fees. 12b-1 fees is named after the Investment Company Act of 1940. It's the section 12b-1 that allows these fees to be charged. The Securities and Exchange Commission allow these fees to be up to 1%, a maximum of 1%. And it's for, these fees are for distribution costs such as advertising and marketing to prospective investors. And it was a very big controversy. These 12b-1 fees came about legally in 1980, according to the Investment Company Act of 1940. It was in a lot of litigation, and here's the story behind the litigation. If you and I are an investor in a portfolio, we're getting charged management fees, accounting fees, legal fees. It all makes sense, and it's not that much generally. If you go into a low-cost fund, it's not that expensive, and it makes sense because we're getting those services, and so we're paying for them. But what happens if the investment company, like Fidelity or T. Rowe Price, decides to start charging these 12b-1 fees because they're advertising to other investors? And you got to ask yourself, if I'm sitting in that fund, why am I paying advertising costs? I'm not getting any benefit from this company. The investment company that manages the fund, they're getting the benefit because the fund gets bigger. They're going to get charged. They're going to charge more fees and collect more fees. So they're really paying advertising out of my pocket and your pocket. So that got the attention of the Securities and Exchange Commission. But the companies that manage these funds, open-ended funds, said, look, we can get some economies of scale out of this. Don't forget. But remember, economies of scale are hard to, that's hard to measure. You're not always sure when you're going to get economies of scale when they come about. It could be you could be on the up end of the curve. You could be here in this area, and you still could be charged 12B1 fees, and so you're really not getting economies of scale, which come about right here at this end. So keep that in mind. Now, the next thing we want to do is let's talk about share classes. There are many mutual funds now employ a fee structure that depends on the type of the class of shares that you own. And the typical share classes are called A, B, C. They could, and it's alphabet soup. You can get J shares and S and T shares, and if you read the Wall Street Journal, you'll see little footnotes that say S and T and so on and so forth. Now, some funds have share classes that are different names to them, and for example, Vanguard will have investor shares, they'll have admiral shares, and they'll have fancy names to them to make it sound good. But the point is that different classes indicate different fees that you're going to pay. And so, for example, you could have Class A shares. Class A shares, you're going to get charged normal operating expenses of the fund, but you may get also hit with a front-end load, 2 to 3%. You could be hit with some 12B1 fees that are modest. If you go into B shares, you may get recurring fees and expenses, high recurring fees and expenses. So you may get hardly any load associated, which are non-recurring, but you may get hit with a lot of recurring fees and expenses, which is a problem if you invest long term. If you invest long term, you get hit constantly with a 1% fee, say for 20 years. That's 20%, and compounded it's going to be more than that. So you don't want to invest in a fund long term that charges high recurring fees. You'd rather get a hit all at once up front with a load. But I can tell you this, you can get funds that have no loads, no front end loads, and have very low fees to begin with, and so they're the best of all the funds out there. There's other Class C's and, like I said, S's and T's with all sorts of different fees. You're going to have to read the prospectus to figure out exactly what those fees represent. But you go to, Fidelity is pretty good nowadays in terms of fees. Pretty low. Vanguard is known around the world for low fees and expenses. And so you go into those types of funds, and you're in pretty good shape. There's a lot of them that are actively managed investment companies that just charge fees that you shouldn't be paying. They're quite high, and I'm talking, when I say high, over 1% is high for me. Even 0.75% is high per share costs, and you shouldn't be paying any front-end loads. Now, let's talk about how to measure expenses of a fund. If you go to any fund, you're going to see expenses measured in an expense ratio. An expense ratio is computed as the annual, let's get that in here so you can see it, annual operating expenses, right, plus 12B1 fees will be included. 12B1 fees typically not part of the operating expenses, they'll separate them out, divided by the average net asset value for the year. So this expense ratio, while it says annual operating, so you might think, well, okay, you only get whacked once for this fee. Actually, this fee gets accrued and allocated every single day. So they estimate this fee for the whole year, divide it by 365, and accrue the expense every day. So every day there's a little bit lopped off instead of all at one point, because otherwise you'd wreck the NAV on any given day at the end of the year when you decided to charge these fees, and the net asset value would drop and plummet for the amount of the fee, and it would be unfair to investors that held that day. So they allocate this fee every single day to the fund. So let me give you an example here. Suppose a fund has annual, if you can read that, annual expenses, operating expenses, right? And let's say they're $2.5 million operating expenses. 12B1 fees. Let's see, let's say they're $500,000 for the year, and the average net asset value is $300 million. So this net asset value will be a daily average. If you just did a quick 2-point average, you know, let's say the fund at the end of the year had $500 million, and it had let's say it had at the beginning it had 200 million, and then at the end it had 400 million. You just take a simple average and you get the 300 million. That's just a 2-point average, beginning and end. But they'll calculate this average for a daily average throughout the entire year. That's what the average NAV is. So the fund on average is about 300 million for the year. So what is the expense ratio in this example? Well, the expense ratio would be to 2,000,005. I'm going to chop the zeros off here to make it easy, and then the 12B1 fees are $500,000, so it's a total of $3 million in fees, and the average NAV is 300 million, so that's going to be 0.01 or 1%, okay, which I would say is a little high. You can get S&P 500 index funds, like through Vanguard, right? Through Vanguard, that, believe it or not, go back to the Economies of Scale graph from the very beginning of this presentation, that are about 10 to 12 basis points. Okay, that means 1/10 of a penny approximately per dollar invested. Yeah, so 10 basis points really translates to, for every dollar invested, think about it, if you had for every dollar invested and you had a 1% fee, you would be paying 1 penny, right, for every dollar. But this is 1/10 of a penny right here. So that's how low the costs can get with certain mutual fund complexes like Vanguard. Even Fidelity has low ones like that for a passively managed index. Now remember, a passively managed index fund, there's no professional portfolio manager for the most part. You have to just mimic the S&P 500 and buy the shares in the right weight, and be aware of that. So it's really basically computer mechanized, so that you keep continuously buying the right shares on a day-to-day basis. There's no active portfolio management. There's no giant team of researchers trying to find the best stock. The set of 500 stocks in the it's set. That set of 500 stocks, it's unchanging for the most part. It'll change maybe as the S&P people just decide to delete some stocks out of the 500 index and add some in periodically to keep it up with the changing economy, but the costs are quite low. Let's now do a problem here, which is a little interesting, I think kind of interesting, and the problem that we're looking at is going to be, which class of shares should I buy? Should I buy a class A or B or C, right? And given my horizon, which one should I buy? And so that's the point. So you got a horizon, you got an anticipated time period that you want to hold your shares for and your stock in this fund. Okay, it could be a year or so, 2 years, and you also have at your in front of you various classes A, B, and C shares, and they have recurring fees, and some of them have. And they all have recurring fees, but the recurring fees could be small. This could have big front-end loads, and so you got to try to balance all that out given your time horizon. So The point is, and I hinted toward this earlier, was that if you have a long horizon, you should stay away from high recurring fees, especially that have 12b1 fees. Lots of funds do not charge 12b1 fees, so you probably want to stay away from them, but there are funds that do charge them, and then you may be forced to buy them somehow, some way. So how do you deal with this? So let's look at a problem. Let's say we have Class A, and we have Class B, and we have a front-end load of 4% for Class A and 0 for Class B, and we have 12b1 fees annually that are 0 for Class A and 0.5% for Class B. Okay, and let's say we have so let's put up here front. Let's say we have a back end load, okay, of 4%, okay, and it drops 1% for each full year invested. Okay, so it's a sliding scale until you get to 0, and so it drops to 0. So now the question is, and one more thing, operating expenses are 12%. Okay. Oh, sorry. The portfolio's return net of operating expenses is 12%. So the return that the portfolio is generating minus the operating expenses is 12%. I was going to say 12% operating expenses. If you had a fund that had 12%, you should run for the hills. Nobody has a fund like that. So you'd stay clear of it. So now the question is, let's say you have a 2-year horizon. You have a 2-year horizon. Oops. Which fund is better for you? A or B? Which fund is better in this scenario? Let's figure it out. So you got Class A shares, and you got $1. So the best way to look at this is, let's say you invest $1 today. Multiplying by 1 doesn't do anything, so you don't really even need this number, but I'll put it there it makes it a little more concrete. Now, if you pay a 4% load, you're going to be left with $96 actually. 96 cents actually gets invested. Okay, so that 96 cents, which is right here, will earn 12% right after you take out the operating expenses for 2 years. It'll compound out. That'll be $1.204. Okay. Class B is, let's see, you invest $1. Since there's no front-end load, right here is 0. 1 minus 0. All your money goes to work for you. Okay. Now, you're going to have that 12% portfolio return net of the operating expenses, 0.12, but you're going to be paying 0.5% in terms of 12b1 fees, right? And so you need to take that into consideration, and that's going to happen over 2 years, compounded over 2 years, and you end up with $1.243. So which is the better investment? Well, you're better off, given that you have a 2-year horizon, you're better off investing in Class B, because you end up with $1.24 versus Class A, which is $1.20. In other words, if you have a short horizon, you're probably better off with the with some type of recurring fee rather than a high front-end fee, a one-time fee. A one-time fee will have a big impact on the 2-year horizon than a recurring fee will tend to have over a short, because you're only getting dinged twice over 2 years. Over 2 years, you're getting hit twice with that 0.5% fee. Okay. Now things change if you have a 12-year horizon, 12 years. Things will change. So you put A here, Class A, so you invest $1, you lose 4% right off the bat, okay, and then you earn that 12%, which is net of fees for 12 years to the 12th power, and Oop, no, make it 18 years. I got to calculate it to 18 years. Let's go 18 years. And you take this to the 18th power, and after 18 years you have $7.38 approximately. 730, you can't read that, that's 738 approximately. Class B shares, now you invest your dollar, right? And there's no fee, and you're earning 12% of your portfolio less operating expenses, right? Plus minus your 0.5% right here, right? So that's a reduction. Take that to the 18th power, and you end up with 7095. So the winner is Class A shares, because notice what happens is you're getting 0.5% for 18 years. That's approximately 9%. Because of just the 12B1 fees, right, over 18 years, whereas here you're getting hit with just 4% once. So you're better off with a long horizon to go with the one-time expense than it is to get hit with a small recurring fee for 18 years, 18 times. So that's how you do the comparison. You might ask, and this is kind of fun, you might ask, at what point are you indifferent? Because basically what we're saying here is, if you look at the calculations I just did, you're going to realize that at some point between 2 years and 18 years, there's a point where you're indifferent between investing in Class A and Class B. Okay? At some point you're indifferent. At what point would that be? Well, you're going to have to solve for an exponent, t. Let me show you. The way to do it is, you're going to take $1, and for Class A, this is the formula, right? This is the formula. This is the earnings that you're going to get over t period for Class A. You want that to equal what you get in Class B. Okay? Which is $1 times 1 minus 0, because there's no load, times 1 plus the 12% for the portfolio return minus the operating expenses, minus 0.5% for the front end load, or for the 12B1 fees to the T power. Okay, so now this simplifies down to 0.96 times 1.12 to the T power equals 1.115 to the T power. Okay, and you're left with that exponent. That's always hard to solve, right? In algebra, you're not used to solving for exponents, but we can get around that pretty easily. That's not too bad. Remember, when you have exponents, you want to get rid of the exponents and solve for it. You probably want to take natural logs. And the natural log of 0.9, and so here's the formula. I'm going to run out of space in a second here, but let me give you the formula. If you have y equals a to the b t power, if you take the natural log of both sides, the natural log of y will equal the natural log of a plus t times the natural log of b. And so that way you take these natural logs. That's that little ln button, that little button you never, you see but you don't know what to do with on your calculator. That's that ln button, and it's the opposite of the e to the x button, continuous compounding. So you want to reverse the process. It's ln. So that's what I'm doing here with I'm using little ln here. Your calculator probably has a capital ln on it for natural log. And so when you put it down in this form, it becomes quite simple because it's all linear, and you can solve for t, like you normally solve for x in some equation. So therefore, take the log of both sides of this equation. Take the log of both sides here. So this becomes minus 0.0408 plus 04 to T times 11.1133. So in other words, if you take the log of 0.96, it equals this, right? The T comes down in front, and this is the log of 1.115. Nope, 112. This is the log of 1.12. Is this equals, take the logarithm, the natural log of 1.115, and put the T in front of that, and that'll equal the log T times 0.10885. Okay, now solve for T, and that's not too bad. When you do that, T equals 9.19 years. You should be able to do that with, you may not have done it for a while, but if you put a little time into it, that shouldn't be too hard. So the answer is, and again, it should make sense though, you're indifferent at 9 years. It should have been between 2 and 18, and it was. So you can graph this out. So you put T on this axis. Hopefully you can see this. I'll write this out for you. You can graph this out. You can put dollars up here, and so you got A growing at a fast rate here because it's growing at 12%, so it grows a little faster, right? But it starts out low because it has the front end fee early on, right? So at 2 years, this was $1.20, and then for B, it's going to look like this. And at 2 years, this was $1.24.3. These are numbers I calculated a few minutes ago, so you can look up in your notes there, right? This is at the 2-year mark right here. Then at the 9-year mark, which is what 9.19 years, we're indifferent. Okay, and then at 18 years, this comes out to be, B comes out to be worth 7.095, and A comes out to be, I didn't draw it very well, but A comes out to be 7.382. So A is the winner for a 18-year horizon, but B is the winner on the 2-year horizon. You're indifferent at a little over 9 years, and that's how you would draw that graphically. Some final points that are worth mentioning about mutual funds. Since mutual funds are managed by savvy financial professionals, the general public often thinks that they outperform the market on average, and it's not so. It's not the case. Many studies show that the average mutual fund underperforms the S&P 500, and they're doing proper comparisons, which I'll talk about in a minute, meaning proper benchmarking. And so after you consider, keep in mind that they underperform in part because they incur expenses relative to an index. Remember, we covered stock indexes in Chapter 5, and there was no adjustment for any expenses. The indexes we were looking at were just simply monitoring prices of the stocks. But with a fund, it charges expenses, so it's likely to cause it to underperform the benchmark, all else being equal. Not only that, but the studies show that even when you adjust for that, there's little to no outperformance of a typical mutual fund relative to the S&P 500. This fades in, the general media, or at least the financial media, and their opinion of whether or not the market is outperformed by mutual fund, it varies over time. So it wasn't long ago when the stock market crashed in 2008 and 2009 that everybody was screaming, look at those index portfolio managers. They did horrible because the portfolios dropped by 50-60% because that's what the market did. So many people were claiming that passive portfolio management and indexing was dead, and you were crazy to index. Now, if you listen to the media carefully, you hear nothing but the opposite, because it turns out that the average fund is outperforming, has actually outperformed the S&P 500. And so now the rave is indexing, and so Vanguard has had billions and billions of dollars pour into its complex just recently around that idea. We'll talk more about why indexing from a theoretical perspective is good, but long-term investing in mutual funds is the way to go. Now, some investors also believe that past performance of a fund is a reliable way to pick a mutual fund. And again, that's not the case. Morningstar, which is a mutual fund rating company, its life is to rate mutual funds and rank them and compare and study them. And they have a rating system which consists of 1 to 5 stars. And so they're rated so that investors can take a look at those funds and get an idea whether or not they should invest in them. And even Morningstar will admit through its research that its rating system is less reliable than expense ratios in predicting fund performance. In other words, funds that have low expense ratios return higher amounts to the shareholders and tend to outperform other funds that have high expense ratios. So keep that in mind. The third item I want to talk about is survivorship bias. It's extremely important in any study of mutual funds. So you have to be very wary of any study on mutual funds, because if the people who are putting together that research doesn't know some of the issues involved, the results are almost useless. And let me explain. Survivorship bias is this. If you sit right now and you look at all the existing funds all the funds that exist right now, and you trace their history back 10 to 20 years, you may find that these mutual funds that you trace back 10 or 20 years outperform the market. And it's like, well, that sounds, the right way to do it. But you got to keep a couple of things in mind to put this into perspective. And here are the items you need to keep in mind. First off, that mutual fund sponsors incubate funds. And what I mean by that is they incubate funds, and they shut down poorly performing funds. So a mutual fund will start up maybe a half a dozen funds in a given year on a variety of different types of asset classes and strategies. They start up a half a dozen. Within a year or so, they'll close down maybe 4 of them, and they'll keep 2. And so how do they make the decision on what to keep and what to close down? Well, the ones that are performing well tend to have a lot of money in them, because investors tend to chase returns. And so, which relates to the item I just talked about. So they chase returns, and so those funds tend to have a lot of money invested in a lot of investors. Okay? So what happens is a fund starts 6 funds. An investment company complex starts 6 funds, gets rid of 4, and what they do is they send out a letter to shareholders. And when I used to work in the industry, I used to read these letters that my client, which was the mutual fund complex, was sending out to its shareholders. And these letters would say, look, the fund that you're in is going to be closed down, and we'll give you a choice. Either you get your money back, or we reinvest your money into one of our other funds with a similar strategy, so you can keep your money invested with us. And so what you have is, if you look now, so what happens is those funds are no longer existing. They don't exist anymore. So if you go and you look at the record of existing mutual funds today, there's no record of them, because they've been dead and buried. You're only looking at the mutual funds that are alive today, and you search and trace them back. You're going to see a sample that looks pretty good, but your sample is biased. It did not include all the mutual funds that existed. And when you invest going forward, some of those funds may die off. So it's a very common strategy for mutual funds to incubate, investment companies, the sponsors, mutual fund sponsors, to incubate funds. And they get rid of the poor performing ones. Now, it turns out that the research shows that some of the funds that die are the ones with very high expense ratios. they have very high expense ratios. They're not doing too well, so they try to hit a home run. And if they strike out, they die. And if they don't, by luck, they end up doing well. They're in the universe of existing mutual funds, and those are the ones that get picked up in the statistics. So the point is, if you do an analysis of mutual fund returns over a period of time, you need to include every single fund in there. Otherwise, you have survivorship bias in your portfolio, or in your sample. Another thing you need to keep in mind, that fund performance needs to consider risk and risk-adjusted returns. Mutual funds that take high risk over a long period of time, you would expect on average for them to outperform mutual funds with low risk. So if you're doing comparisons, make sure it's on a risk-adjusted basis. And the other thing you want to keep in mind is that when you compare mutual funds, or any fund, any portfolio, including your portfolios in StockTrack, you need to make sure that you have a valid benchmark. And what I mean by a valid benchmark is this. There's a couple criteria for a valid benchmark. The first is the benchmark should be appropriate, meaning the fund has the same style as the benchmark. And style would be, for example, growth or value, or a certain sector. If your portfolio isn't in a certain sector, then you want to compare it to other funds in similar sectors. If it's small stock portfolio, you want to compare it to other small stock portfolios and small stock indexes for comparability purposes. You don't want to compare a large cap index like the S&P to a small cap portfolio or a small cap mutual fund. So make sure that you're looking at the same style. The benchmark should be identified in advance. So you shouldn't be backtracking on your benchmarking. In other words, you'd be subject to cherry picking. So what I mean by that is, after the fact, you decide that you want to benchmark against a certain portfolio. Well, you can cherry pick and pick the specific portfolio that makes your fund look good, and investment companies can do this. And so you need to be aware of that. You should have an identified benchmark that's known in advance. The benchmark should be unambiguous, so you know the weights and the risk exposure, so that you can duplicate that benchmark, because that should always be an option for you when you're looking at portfolios. If I'm managing a portfolio in StockTrack and I want to mimic, say, the S&P 500, I need to know exactly what those weights are, so I can make the proper comparison. It also, the comparable benchmark should also be a viable alternative, something you can actually invest in, and not something that's impossible for you to get your money in. It's probably not an appropriate benchmark for comparative purposes. And you also want to be able to easily measure the returns of the benchmark over time. So you need to consider that. There's a whole literature on how to benchmark and compare portfolios against others. You'll get a good I think you'll get a good intuition at a benchmarking from playing StockTrack and watching your portfolios go up and down relative to other portfolios of other students, and also relative to, say, the S&P 500 and the Dow Jones. You'll have some intuitive feeling for that. But I just want to let you know that there's an entire literature about that, because it's very important. Relative performance, as we talked about in previous lectures, is important.